Match Group owns dating apps Tinder and Hinge. Last week, the company reported earnings, but investors were not impressed. Shares plunged 15% and are now 83% below their all-time high. After the drop, Match now has a current market cap of $8.7 billion. The company's made $500 million of net income over the last 12 months and almost $800 million of free cash flow. So the stock is valued at 17 times earnings and 11 times free cash flow. That looks far too cheap for a business that is still growing. In the third quarter, revenue increased 9% year over year and earnings per share jumped 30%. So why did the stock drop? The main concern comes from the company's biggest asset, Tinder, which makes up 60% of total revenue. While Tinder revenue increased 9% in Q3, that increase came entirely from higher prices. The number of paying users on the app actually declined by 6%. That's a problem for a couple of reasons. First, Match can't keep raising prices forever. When it stops raising prices, revenue growth will stall. Second, the nature of network effects means that fewer users on the platform means fewer matches and a worse experience all round. On the other hand, Match's Hinge product is performing well. Revenue increased by 44% in Q3, and the number of paying subscribers grew by 1/3. In the latest shareholder letter, management projected continued strong performance for Hinge next year and improving growth for Tinder as well. However, they said a similar thing last year. Let's assume Hinge manages to grow revenue at around 25% per year for the next 5 years, while Tinder and Match's other apps grow 5% per year. Total revenue in 5 years' time would be roughly $4.8 billion. With a 15% net income margin, that would put Match's profits at roughly $720 million in 5 years' time. Using a 20 times multiple, that would put the valuation at $14.4 billion, which works out to an investment return of roughly 11% per year. That might not be a high bar, but Match also has $4 billion of debt on its balance sheet, so earnings will continue to be impacted by debt repayments and stock-based compensation. A subscription to Tinder isn't cheap. The monthly cost can run to $27 a month with extra charges on top, and last month the company announced a premium tier costing $500 a month. The app has been over-monetized, which has affected its appeal among users, and that experience could also play out with Hinge. For that reason, I'm giving this stock a neutral rating, but these are my personal opinions, not financial advice, and I've got no position in Match. To see more videos like this, make sure to check my new website, 3minutebreakdowns.com. Thank you for watching.